Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is July 23rd, 2025, and we're diving into Renasant's second quarter earnings report for 2025. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Renasant has been in the spotlight recently, especially with their merger with the First Bancshares, Inc. This report gives us a first look at how the integration is impacting their financials.
Revenue and profitability overview. Let's start with the top line. Renasant reported a net income of $1.0 million for the second quarter of 2025. John, how does this compare to their previous performance?
It's a significant drop from the previous quarter's $41.5 million, primarily due to merger-related expenses and a day-one acquisition provision for credit losses. However, the adjusted EPS of 69 cents aligns with last year's performance, indicating underlying stability despite these one-time costs.
And what about their net interest income and margin?
Net interest income saw a substantial increase to $222.7 million, up $85.3 million from the previous quarter, largely due to the merger. The net interest margin also improved to 3.85%, reflecting better asset yields and cost management.
Merger impact and strategic initiatives. The merger with the First Bancshares was a major event for Renasant. Can you tell us more about its impact?
Absolutely. The merger, completed on April 1, 2025, brought in $7.9 billion in assets. This has significantly boosted Renasant's scale, with net organic loan growth of $311.6 million and deposit growth of $361.3 million for the quarter. These figures highlight the strategic benefits of the merger.
How is Renasant managing the integration process?
According to CEO Kevin D. Chapman, the integration is progressing well, with employees working diligently to merge operations. This is crucial for realizing the full potential of the merger and serving their expanded customer base effectively.
Credit quality and financial health. Credit quality is always a concern during mergers. How is Renasant faring in this regard?
Renasant recorded a provision for credit losses of $81.3 million, which includes a significant day-one acquisition provision. Despite this, their allowance for credit losses on loans is stable at 1.57%, and non-performing loans remain at 0.76% of total loans, indicating sound credit management.
What does this mean for their financial health?
It suggests that Renasant is maintaining a healthy balance sheet, even as they absorb new assets and liabilities. Their ability to manage credit risk effectively will be key to sustaining financial health post-merger.
EPS forecast and analyst expectations. Analysts had forecasted an EPS of. How did Renasant's actual performance compare?
The adjusted EPS came in slightly below expectations at 69 cents. This shortfall is primarily due to merger and conversion expenses, which impacted the bottom line. However, the core operations remain strong, as reflected in the adjusted figures.
What should investors take away from this?
Investors should focus on the adjusted EPS and the strategic benefits of the merger. While the immediate costs are high, the long-term growth potential from the expanded operations is promising.
Key takeaways. In summary, Renasant's second quarter results reflect the challenges and opportunities of their recent merger. While net income was impacted by one-time expenses, the underlying business shows resilience. John, any final thoughts?
Renasant is well positioned for future growth thanks to the merger. The integration process is crucial, but the potential for increased market share and operational efficiencies is significant. Investors should keep an eye on how these synergies develop.
Thank you, John, for your insights, and thank you to our viewers for tuning in. Don't forget to like, share, and subscribe to Smart Stock Watch for more financial analyses. We'd love to hear your thoughts on Renasant's performance in the comments below.